Hello traders, this is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. This video is going to speak on IPDA data ranges. This concept helps traders prep for a new trading month. With that being said, let's get into our disclaimer. Do your own research. My content is intended to be used for informational purposes only. Please do your own research before making any investment or trade based on the information provided, and consider your own personal circumstances. You can talk to a professional or do your own independent due diligence on verifying any information that you find on my channel. This is a message from myself, Deontay, as I am not a professional. With that being said, let's get into our lesson. The Forex market is algorithmic. Price action is not random, it is specific. There is an entity that controls price action we see on our charts. That entity is called IPDA. IPDA stands for Interbank Price Delivery Algorithm. It is in charge of many components that make up Forex. Without IPDA, markets would move randomly. Traders studying IPDA realize the markets are coded. We know that the market likes to react at a certain time and within a certain level. So we know that it's not randomly shooting up and shooting down. We know that there's some type of strategic thought process and structure the way the markets move. The market uses past data in order to create new data. The market is typically gearing off of a 60-day look back for its information. Within this model, we're going to be looking back 20, 40, and 60 trading days from the first trading day of the month. Note of all the highest highs and lowest lows within each look back period. That means for 20, 40, and 60, we're looking for the highest high and lowest low within those time periods. Let's take a look on the charts and what that looks like. So we're looking at the pair AJ, Australian dollar versus the Japanese yen. And we're going to start off at the first of the month. So the first trading day for the month is right here, September 1st. So we're going to bring it back to September 1st. And once we get to the first of the month, we're going to count back 20, 40, and 60 days. Now, my way of doing it, quick and easy, is by using this tool that they have on TradingView and going back 20 bars. Since this is the daily time frame, 20 bars would be 20 days. So that would be our 20-day look back period from September 1st. And then we'll go back 40 bars. That would be the 40-day look back period. And then we'll do it one more last time for the 60-day period. 60 bars. And there we have our look back data ranges, 20, 40, and 60. Now that we have the 20, 40, and 60 day look back period delineated, we can now note off the highest high and lowest low within each time period. Let's do that now. So we'll come here to the 20 day and we'll find the highest high and the lowest low within this range. That highest high would be right here. You can see it's right here. So we'll mark that off as the 20-day high. Then we can see that we have the lowest low come in right here on August 5th. I'll mark that into blue. So that's our first bracket of time. The highest high and lowest low in the 20-day period. We'll do the same thing here. Now that we have all the highs and lows marked off for the respective look back ranges, we as traders can speculate greater now that we have these specific highs and lows. Let's talk about how we can speculate the market going into each new trading month with IPDA look-back data ranges. The first thing I speculate going into a new month using IPDA data ranges is going to be the trading range that I'm trading in. So how do I normally find that? Well, I take the highest high and the lowest low that we have in the last 60 days, and that would look something like this. So we have to get rid of this high, this low, and this high. This is our current trading range. Price was trading inside this high and this low within the last 60 days. So this will give us more insight to see what range we're in. So we can cut this range in half. And then we'll be able to find our premium and discounted range. So we can see that this is going to be premium. Anything above 50% or equilibrium is premium. Anything below it is going to be our discount range. And we'll put that in blue. So whenever price is in the red, you have probabilities or higher probabilities of finding a sell setup. And when price is in the blue, you have higher probabilities of finding a buy setup or a buying opportunity. So this can help us define whether we should be seeking buys or sells just by finding the largest range that we're trading in within the last 60 days. Speculate going into the new trading month using the IPDA data ranges are going to be the higher time frame liquidity pools that we have left. So I'm looking for the highest highs and lowest lows that are intact, that have not been broken, going into September 1st. So we're going to find those. So this high here we can see is broken going into September 1st. So this high claims it. So we're going to get rid of this high here. We can see that this low here is broken. This low claims it. It's lower than it. So we're going to get rid of that. So this low is still intact. This low is still intact. This high is still intact. And this high is still intact. Meaning price action has not mitigated or broken this high, or broken this low or low. This is where our higher time frame liquidity pools are. This is going to be where the market is most likely going to draw towards. Now we could use speculation and further investigating in our trend. Are we still bullish or bearish going into this month? Are we most likely going to take out the buy stops or the sell stops? Here I can see and only imagine that price will take much more greater effort to get down here to the sell stops. It would be an easier path of resistance for price to run to these buy stops because it's closer in nature. The last 20-day high could be an easy target reach for the market makers, and also the 60-day high. If market were then to turn around here, it will most likely aim for the 20-day low and the 40-day low. The IPDA data ranges can also be casted forward from the beginning of the month, 20, 40, and 60 days into the future. This is going to help us anticipate a quarterly shift that could potentially unfold during this new trading month. Same way we find our look back data ranges is how we're going to find our cast forward data ranges. So we're starting on the 1st of the month and we're going to cast forward 20 days. That's going to be September 29th. We're going to cast forward 40 days. That's going to be October 27th. And then we're going to cast forward 60 days. November 24th. So now we have our casted forward data ranges, and we can now pull those significant highs and lows that we got from the look back data ranges going forward. Within this time period moving forward 20, 40, and 60 days, we can anticipate a quarterly shift occurring. This does not mean every single month does price break a high or low and then create a higher time frame reversal, changing its trend and direction, going from a bullish cycle back to a bearish cycle, or a bearish cycle back to a bullish cycle. This normally occurs every 3, 4, or 6 months. But as a trader, it's your responsibility to look for the signs and key warnings that price may be looking to do a reversal and change during a quarterly shift going into a new trading month. So these are things I keep in mind when using IPDA. This brings me to the main concept of the lesson. Use IPDA at the beginning of a new trading month. IPDA can show you the current trading range price is trading within. IPDA gives reference points to where obvious liquidity is resting. The market will make a quarterly shift every 3, 4, or 6 months. This sets traders up to anticipate a quarterly shift if key highs or lows are broken. IPDA is another raw price action indicator. Let's take a look at some IPDA magic. So here you can see February 6, 2022. I was using February 1st. I was counting back 20 days. I found a 20-day high and I used it as a run on liquidity, on buy side liquidity. So I framed a buy setup, and you can see here I was able to acquire that trade and it was successful. And there was definitely other ideas blended to come to that conclusion to why I think, UJ was going to be bullish going into the month and not bearish. But you can see how IPDA gave me the easy target of where liquidity was resting, and it was right above this high. So I just wanted to show another perspective of it. So this is February 1st, the same pair, UJ. I marked off all the look back data ranges and noted off all its highs and lows within each time period, 20, 40, and 60. And then you can see the highest high and the lowest low we have within the last 60 days is our current trading range that price is trading in. You can see that from here to here, price is trading within this range here. So then we're able to cut that in half and find anything above 50% is premium, anything below is a discount. And we know if the markets are bullish or most likely to give us a buy setup, it's going to be in a discounted market. Look to see what price does here. Price comes down below equilibrium trades into a discount, and markets are permitted to buy again. Buys and then runs all the way back up to that 20-day high that you guys saw previously in the other slide. So here you can see October 4th, 2021. I published this. You can see that prior to October 1st, the last 20 days, you can see the high is marked off with an X. That high is broken here on October 4th. But if you cast forward 40 days right here, specifically on this date, November 26, 2021, you'll notice price on that day, that 40-day cast forward day, makes a large candle to the downside, taking out that 20-day sell side liquidity pool, that 20-day low. And we'll show it one more time. So from there, cast forward 40 days. And you can see how price makes that shift down to take out the sell side liquidity. And then it then turns back around, running higher. Second, 2022 is AU. We're looking at January 3rd, which is the first official trading day of the month. And we look back 20, 40, and 60 days. So then we have our IPDA data range. We have the highs and lows of the respective periods. And you can see how price will then take out this 20-day high, runs up, hits the old 60-day low, runs lower, and takes out the 20-day low and the 40-day low, runs back up, breaks that 40-day high here, and that 60-day high here. So those unbroken highs is where the buy side liquidity was most obvious for price to draw and reach into. So it's not random. If the markets were truly random, it wouldn't have specifically ran to this high and this high here. That brings me to the end of this lesson. Like always, I'm going to leave you guys off with a quote. We cannot solve our problems with the same thinking we used when we created them. Albert Einstein. Thank you and peace.